On August 6, 1945, the moment news of the Manhattan Project became public, the Anaconda Copper Mining Company lost 12% of its stock value in a single afternoon. That single fact tells you everything about how government secrets work inside financial markets. When a secret is kept, money flows one direction. When that secret breaks, fortunes evaporate overnight. And the people who knew the secret first walked away with everything. This is not ancient history. This is not theoretical economics. This is a pattern that has repeated itself across 70 years of declassified government records, and almost nobody in the financial world talks about it directly, because the implications are deeply uncomfortable. When governments reveal what they were hiding, the economic shockwaves are not random. They follow predictable patterns that destroyed certain industries and created enormous wealth in others. Today we are going to walk through the most significant examples, sector by sector, dollar by dollar. The Manhattan Project cost $2 billion in 1945 money. That is approximately $28 billion in today's currency. Every single dollar of that was classified. But the project consumed enormous quantities of raw materials: copper for electrical wiring, uranium from mines in Colorado and Utah, steel, aluminum, all of it purchased through classified procurement channels at above-market prices. Certain mining company executives received contracts they could not explain to their shareholders. Revenue was climbing, but the source was a black box. Wall Street analysts noticed the anomaly but had no explanation for it. When the bomb dropped on Hiroshima and the project became public knowledge, two things happened simultaneously in financial markets. Uranium stocks, the moment traders understood what the bomb actually was and what it required, began a speculative climb that would last 3 years. But traditional war materials suppliers dropped hard. Anaconda Copper had been quietly benefiting from classified wartime contracts. When the war ended publicly and the classified nature of those contracts became partially understood, investors could no longer rationalize the company's revenue streams. The company's books told one story, the public explanation told another, and when those two narratives collided, the market rendered its verdict in hours. Meanwhile, a uranium speculation frenzy erupted across the American West. Small mining companies that had been entirely unknown to Wall Street suddenly attracted speculative capital from investors who understood one simple equation. The secret had been the fuel source. Once that secret broke, everyone who positioned themselves correctly in the weeks following the announcement made extraordinary returns. Companies like Uranium King Corporation and the Uranium Ore Corporation saw their penny stocks multiply by factors of 3 and 4 within months of the disclosure, and every single one of those gains came directly at the expense of investors who had been holding conventional war materials stocks that were quietly displaced by the atomic program. The pattern established in 1945 would repeat with stunning consistency. The secret creates distorted markets. The revelation corrects them violently. In 1954, the CIA conducted Operation PBS Success. Its goal was the overthrow of Guatemalan President Jacobo Arbenz. The classified reason, buried for decades in agency files, was the protection of United Fruit Company's land holdings, which Arbenz had begun nationalizing. United Fruit Company's stock had been declining steadily since 1952, as Guatemalan land reform threatened the company's 200,000 acres of banana plantations. What the general public and most of Wall Street did not know was that senior figures connected to United Fruit had extraordinary access to the Eisenhower administration. Secretary of State John Foster Dulles had previously worked for a law firm that represented United Fruit. CIA Director Allen Dulles had sat on the company's board. These connections remained classified or simply unacknowledged until 1975, when the Church Committee investigations began pulling back the curtain on covert operations that had shaped American foreign policy for decades. The moment those hearings became public and the full scope of CIA corporate entanglements became visible, the political and financial cost became undeniable. Investor confidence in any company with heavy government contract exposure dropped measurably. The Church Committee revelations triggered what financial historians now recognize as one of the first modern ESG crises, before that term even existed. Companies with substantial CIA or Defense Department relationships saw their public valuations compress as investors tried to calculate the legal and political risk of those relationships becoming public. United Fruit had already attempted to rebrand itself as Chiquita Brands International in 1970, partly in anticipation of exactly this kind of exposure. The rebranding cost tens of millions of dollars. That rebranding was essentially a financial hedge against the declassification risk they knew was coming. The companies that anticipated declassification exposure and restructured early preserved far more shareholder value than those that were caught exposed when the documents finally surfaced. This is a principle that sophisticated investors would eventually learn to systematically apply. On June 13, 1971, the New York Times began publishing the Pentagon Papers. Within 72 hours, the defense sector of the American stock market entered a sustained decline that would last 4 years. The Pentagon Papers revealed that the Johnson administration had systematically lied about the effectiveness and scope of the Vietnam War for years. 7,000 pages of classified analysis that showed military leadership knew the war was unwinnable as early as 1967. What the market priced in immediately was not just the moral outrage. It was the financial reality that a war the government knew was unwinnable had been consuming $60 billion per year in defense contracts. Lockheed, McDonnell Douglas, General Dynamics. These companies had built their entire revenue models around the assumption that Vietnam-level spending would continue indefinitely because the official government position was that the war was being won. Lockheed's stock fell 43% in the 18 months following the Pentagon Papers publication. The company required a federal loan guarantee of $250 million in 1971 to avoid bankruptcy. But the collapse was not just about Vietnam ending. It was about what the Pentagon Papers revealed about the entire architecture of classified defense procurement. The papers exposed a consistent pattern where classified project cost overruns were hidden from Congress and the public. When investors understood that the stated values of defense contracts had been systematically inflated in public filings, the revaluation was brutal. The C-5A Galaxy transport aircraft program had cost overruns of $2 billion that had been classified. When those figures became visible through Freedom of Information Act requests following the Pentagon Papers controversy, the revelation triggered immediate congressional scrutiny of every major defense contract. Between 1972 and 1974, the 10 largest defense contractors lost a combined market capitalization of approximately $12 billion. In today's money, that is roughly $80 billion of investor wealth destroyed directly by the revelation of secrets the government had been keeping about its own defense spending. But what is most remarkable about the defense sector collapse is what happened afterward. Because some investors had anticipated the disclosure. Records that have since become available show that short positions in major defense stocks were opened in substantial size in the weeks before the Pentagon Papers were published. Whether those trades reflected foreknowledge of the publication or simply sophisticated analysis of the political environment remains a matter of historical debate. The SEC investigated the trading patterns. The investigation was quietly shelved in 1973 as Watergate consumed Washington's attention. On June 5, 2013, The Guardian published the first Snowden revelations about NSA mass surveillance. By June 10, the technology sector had shed approximately $100 billion in market capitalization. That $100 billion figure is almost certainly an undercount because it only captures the immediate market reaction. The full economic impact of the Snowden disclosures took years to fully register. Verizon dropped 4% in 3 days. AT&T fell 3.5%. But those numbers are misleading because they focus on the domestic impact. The deeper economic wound was international. When foreign governments and foreign corporations understood that American technology infrastructure had been secretly compromised by NSA programs, they began systematic efforts to remove American technology from their networks. Germany launched a national cloud computing initiative specifically designed to route around American providers. Brazil announced a $100 billion investment in domestic internet infrastructure. The European Union accelerated data sovereignty legislation that would eventually cost American technology companies billions in compliance costs. A study by the Information Technology and Innovation Foundation estimated that Snowden's revelations cost American cloud computing companies between $22 billion and $35 billion in lost foreign contracts over the 3 years following the disclosures. But there is a reverse side to this coin that almost nobody discusses. The moment the Snowden revelations confirmed that government surveillance infrastructure was real, comprehensive, and technically sophisticated, the cybersecurity sector exploded. Palo Alto Networks had gone public in 2012. The Snowden revelations effectively validated every product pitch their sales team had ever made. The stock tripled between June 2013 and December 2014. The broader cybersecurity investment sector grew by 340% between the Snowden revelations and 2018. Venture capital that had been cautious about cybersecurity investment suddenly poured in. Venture capital investment in cybersecurity companies went from $1.4 billion in 2012 to $4.7 billion in 2014. That is 335% growth in 2 years, triggered almost entirely by one document disclosure. The secret that crashed one sector simultaneously launched another. This is the economic paradox of declassification. In 1973, the Arab oil embargo sent crude oil prices from $3 per barrel to $12 per barrel in 90 days. Most of the financial world treated this as a surprise. It was not a surprise to everyone. Declassified State Department cables, released in the 1990s, show that American intelligence services had specific warnings about OPEC's coordination plans as early as September 1972. 13 months before the embargo. Those warnings were shared in private briefings with executives from the Seven Sisters, the major international oil companies that controlled most of the world's oil supply at the time. Between January 1973 and January 1974, while the general market fell 17%, Exxon rose 21%, Chevron rose 29%, Shell rose 33%. These companies did not simply benefit from higher oil prices. Their position management suggests they anticipated the timing and magnitude of the price shock with remarkable precision. Senate investigations in 1974 examined whether the oil companies had used foreknowledge of the embargo to position their inventories and futures contracts. The classified intelligence briefings were not disclosed to the investigators. The SEC's own investigation found unusual options activity in oil company stocks in the 3 months preceding the embargo announcement. That investigation's conclusions were partially classified, and the full report was not released until 2003. When the full report finally became available, financial historians calculated that the informed positioning in oil sector securities in the months before the embargo represented gains of approximately $4 billion in 1973 money, $26 billion in today's terms, made by investors who had access to intelligence that the general public and most of Wall Street did not have. The National Reconnaissance Office was established in 1961. Its existence was classified. Its budget was classified. The existence of reconnaissance satellites was classified. What was not classified was the commercial communications satellite industry that grew in parallel. And here is where the story gets economically fascinating. Private telecommunications companies were pouring money into satellite research without knowing that the government had already solved the core technical problems they were struggling with. The classified reconnaissance satellites of the mid-1960s were technically 15 to 20 years ahead of anything the commercial sector was developing. When portions of the NRO program were eventually declassified in the 1990s and 2000s, researchers calculated that private telecommunications companies had spent between $8 and $12 billion on research to solve problems that had already been solved with classified government funding. Hundreds of patents were filed by commercial companies for technologies that had existed in classified government programs for years. Those patents generated licensing revenues that were built on a foundation of unknowing duplication. When the NRO's existence was officially acknowledged in 1992 and key technical documents began flowing through declassification, the commercial satellite industry experienced an immediate restructuring. Companies like Iridium, founded in 1991, benefited directly from technologies that became accessible as the classified barrier dropped. Iridium attracted $1.5 billion in private investment based on technology capabilities that would not have been commercially viable without the Declassified Foundation. When Iridium went bankrupt in 1999, the post-mortem analysis revealed something chilling. Declassified NSA documents showed that the government had internally assessed the business model for a similar commercial satellite system and concluded it was not commercially viable. That assessment was classified. Iridium's investors never saw it. $1.5 billion lost to a secret that should have been irrelevant to national security. The bankruptcy court documents contain no reference to the government assessments that essentially predicted the failure, because nobody in the investor community knew those assessments existed. In 1994, the Brown and Williamson documents became public. Internal tobacco industry research proving company executives had known cigarettes caused cancer since at minimum 1953. Philip Morris lost 11% of its value in the week following the document release. The entire tobacco sector index fell 8.5%, but that immediate reaction was almost trivially small compared to what followed. The 30-year reckoning that the declassified documents triggered rewrote the entire economics of the industry. The 1998 Master Settlement Agreement required the four largest tobacco companies to pay $246 billion over 25 years to state governments. That liability directly reduced Philip Morris's market capitalization by approximately $60 billion, representing the market's estimate of the present value of future settlement payments. But the most economically revealing